Happy Friday morning, everyone. It is about a half hour before the stock market opens, and my colleague Daryl and I wanted to talk about stocks. We wanted to analyze some stocks, maybe talk a little bit about the economic data that was released this morning, and see how things are going to go today. We are on a 3-day losing streak. So if you're a baseball fan, get your rally hat on so we can rally out of this losing streak for a day. What we're going to do on the stream is we're going to do two things. We're going to first, we are going to look at stocks. We have a list of stocks that we could go through. We'd love to get some suggestions from attendees. If you're a member, it's free of charge because you've already paid a membership fee. I appreciate that. If you're not a member, just a $5 super chat, and just put that in the chat, and we can review a stock that of your liking. What we do is we go over fundamentals. Look at a company, look at its revenue growth, its profitability, its free cash flow generation, the health of its balance sheet. We look at forecast of what the business is going to do. I do a valuation on the stock based on future free cash flows as well as future profits and compare it to the current stock price. Daryl looks at the charts and he looks at the what the charts are telling us about that particular stock. Does it have momentum? Is he expecting that it's going to potentially trade up or down? So you get two different perspectives. I think it's really interesting, and I hope you feel the same way. And as mentioned, we are on a 3-day losing streak, but this morning we had some economic data that I thought was, if anything, just telling me that the economy is okay, the consumer's spending money, the unemployment isn't too bad. I know it's not perfect, but I don't think unemployment's becoming a giant problem. And as a conclusion is, okay, the economy's okay. We're in an expensive market, so this sell-off is not like, completely irrational. I think selling off a little bit and getting some of these high prices to be a little more reasonable isn't a bad thing. I think it's all right. But any opening comments, Daryl, that you've got?
Yeah, I can share those numbers this morning and yesterday that because we talked about these on Monday, that these reports would be coming out. So the G2 or Q2 GDP was actually 3.8. Economists were expecting 3.3, and it was actually negative in the prior revision. So these numbers come out with the initial and then they're revised 3 or 4 times, I think 3 times, before they finalize what the growth rate was for that quarter. The initial jobless, so that was a positive. The economy is better than expected. The initial jobless claims were 218. They were expecting 235, 232 prior, which was revised up 1,000 from 231. That's a positive. I think the government layoffs that occurred 6 months ago, I think those roll off at the end of September. So next month, we may or may not see a bump in these numbers. We'll have to keep an eye on that. The continuing jobless claims, so after their initial application for jobless claims, are they continuing to claim benefits for unemployment? And this number was actually lower than estimated and lower than the week prior, even though that was revised up from 1.92 million. So that's a positive. Existing home sales isn't too important. I kind of keep an eye on that for the home builders and also for my Rocket investment regarding mortgages. So that one's not quite as important, but it was better than expected. And then today was going to be the big market mover, and I see that the market is reacting positively to this. I wanted to say one thing that was interesting about these is these good numbers came out yesterday and the market went down.
Yeah.
So my initial thought on that is they're expecting that the Fed might rethink steady decreases in the Fed funds rate. And I went and looked at the Fed funds expectations, and they did indeed actually decrease. So the market reacted negatively, although all this data was good.
Mm-hmm.
And I think it's just because of the risk-free rate changes the valuation on stocks. So then let's get to the PCE, because this is going to be the big market mover for the week. And this is the Fed's preferred measure of inflation. It came in as expected, 0.3, and it was 0.2 prior. Year over year, it came in at 2.7, which matched what was expected. The core, which excludes energy and food, came in at 0.2, and that's what was expected. And year over year, it was 2.9, and that's what was expected. And then go ahead.
And the PCE index, that's personal consumption expenditures.
Yes.
I wasn't sure what that was for a second. I thought it was the P standard for producer. So that's people going to Best Buy, Costco, and buying stuff, or online, going to Amazon and buying stuff. Carry on, sir.
So then the next two reports that came out this morning was personal income. So it's actually higher than what was expected and did match the prior month. And then personal spending was also up. There's going to be, because of inflation, there's always going to be an argument. Did people get more for their money or the same for their money? They spent more but got the same amount of goods. So that argument will happen today, I'm sure, if you listen to the media.
Yeah.
0.5 was expected, and it was 0.5 prior. So
could I say something real quick on those
You
two
bet.
data points?
You bet.
I'm willing to put out there that 90% of the people that attend this live stream and are really online investing and so forth, they don't fit this trend where income is up 0.4% and spending is up 0.6%. I actually think we're the opposite. If our personal income went up 0.4%, our personal spending maybe went up 0.001% because we want to put that money to work.
Yeah.
Why am I going to go buy a new pair of sneakers, man? I'd rather go buy a couple more shares of a stock that looks really good right now. So these numbers obviously are a very big data set. This is a lot of millions of people in the United States. And I believe the numbers, by the way. I think this has just been reality in the United States. But it doesn't mean, like, if you're tuning in the morning on a Friday, you're actively managing your capital, your wealth, and trying to have that capital work. You're not you're not fitting into this particular mold. You're like, hey, I want my capital to work for me. I don't want to go spend it all. Back to you, sir.
Okay, so because this data came in today, we'll see a change on the GDP now from the Atlanta Fed. I didn't pull that up yet to see if they've already made that adjustment, but this would be the next input of data that would adjust this GDP now. So they adjust this as it goes. Every major piece of data that this GDP now relies on, and I can make it a little bit bigger so you can see it, but as data comes in, they revise this. So it's a kind of like a real-time measure, but it can be a little more volatile than some other measures just because they're taking data as it comes in. So anyway, I'll go look at this today and take a look and see how it adjusted.
Great. Thanks, Daryl.
Okay.
All right. So let's see here. We've got a couple comments. Let me just nicely done, Ben 10.
Yeah, very, very good.
I got sneakers on my mind because I actually need a new pair of sneakers, but I'm gonna spend a little time this weekend and head out to there's a Nike outlet on the way to my mom's house. And when I go see her this weekend, I'm gonna stop by, try to pick up a new pair at a discount. All right, so let's talk stocks. Let's talk about stocks. And yesterday we had a stream to go over earnings with Costco. Costco is a big stock. It's really widely held, $418 billion market cap. And the market is selling the stock off. And this is kind of normal for Costco. The stock is so appreciated that investors, when they see the numbers printed, like, oh, those are the earnings, the stock seems a little expensive, they sell it off. And then a couple weeks later, a month later, they kind of forget the numbers and they're like, well, I want to own Costco because it's such a trusted brand. It's such a comfortable stock to have in the portfolio. And if the stock drops, a good amount, investors feel like, hey, I can get back into Costco, or I can get into Costco at a decent price. So we'll see how this trades over the next 60 days, but that's what's going on with Costco. All right. And we're going to cover a couple of stocks. We're going to start with Intel. Intel has been red hot for the last 30 days. It's up 37%. This is a semiconductor. 10 years ago, Intel was one of the big giant technology companies. They were the 800-pound gorilla in semiconductors as they related to the PC and other applications. And over the last 5 years, it went from not doing exceptionally well to doing worse to really, frankly, becoming a dumpster fire about a year ago. Nothing was right. CEO got fired and just a lot of broken pieces to Intel. And those who believed in it, and I know there's some that are members of this channel, got in at the right time because, there was plenty of, well, what's going on here? Looks like our, oh no. Did the website go down? I guess so. I'm afraid to click anything else, but let me give it a try. I don't know if my internet went down. Are you hearing me okay?
I hear you fine. Yep. And I see your screen.
Well, let's see. All right. So maybe stock analysis is having a little heartburn. So anyway, so the 1 year, I wanted to look at the 1 year chart. You see that this stock is up nicely, 42%, but it hasn't been a smooth ride. It's been certain moments, boy, was it a good buy. I stayed out of Intel. I was just really not buying into or believing in their business because it seemed like they were fairly broken. And partnership with the government, they had a partnership with NVIDIA, and now they're working on a partnership with Apple. So that's moving the stock higher. The stock's moved from $19 a share up to $34. So very quickly, investors have seen a really nice windfall in Intel. If you're an Intel stockholder, congratulations. It's been on a tear. I was curious to see if you could look at the charts and see what the charts are telling you.
Yep. Got it pulled up here. So they jumped up on the 18th of September. They are trading above an upward sloping 20, 50, and 200-day moving average, and those are all in the correct order. One of the they are overbought at the moment. The RSI is sitting at 78, which is getting pretty close to very overbought. The PPO is in positive territory, has been since the 13th of August, and it looks like the divergence between these two moving averages is actually getting larger at the moment. One of the curious things that I saw is when this price jumped up, distribution set in. So there were some people taking advantage of the pop in the price to actually sell. But after a couple of days, that looks like it's reversed its trend, but has not regained where it was on the 17th as far as volume and price. So I don't know if I can go back. Yeah, that 17th or 18th of September was a breakout above a quadruple top. So that looks like definitely positive price action. If they can continue this price action, we'll have to just keep an eye on it and see how things progress.
Interesting. Well, let's take a look at their fundamentals. Looks like stock analysis, the website's working for me okay now. So Intel's 158 billion, and it's a small market cap considering that Nvidia is above 4 trillion. It's like a lot of semiconductor companies are much higher in valuation than Intel, and their revenues are quite high, 53 billion. Forward PE is a little high. I think they're really trying to get their act together. Analysts think it's priced a little expensive because it has been trading up. Okay, that's understandable. These guys are just they have been contracting for 3 consecutive years. And the contraction in 22 was quite bad. 23, bad. 24, flattening out, but we're still in a contraction. They cash flow, they don't cash flow. So they're negative cash flow. They used to be a cash flow machine. Look at that, 21 billion in 2020. And they went from 21 billion in free cash flow to negative 11. What happened? And they have the PC business as a cash cow. It's like you just let that run on this side of the company, focus on innovation on the other side of the company, and you become even bigger, more valuable, and return a great return to your owners. But that's not the case. It's just been a really upside down business for a couple of years. Now it's all about, looking forward, not looking back. Their margins have really gotten awful. They went from 55 to 33. That's the opposite direction of what we want to see. We want to see increasing margins. Profit margins used to be 25, 38, just ugly. And the CEO that went into Intel, I think his reputation was solid. He was, from what I knew about him, he was a fairly good choice, right? He was good. But boy, he's probably going to go down on the books as whether it was completely his fault or just partially his fault. Maybe some of the worst performance by a leader of a publicly traded company, an iconic publicly traded company that we've seen for a while. And we'll see. Analysts think it's a little expensive. Not a big surprise because I don't think analysts are all that confident in Intel. I'm not confident in Intel. For all I know, next year they're going to be the bomb fire is going to get a little more fuel and light up again. Revenue is supposed to start growing, so they've really have contracted for years. Will begin to grow according to forecasts, and they're going to get back into a profitability mode. And they have a PE that should get to a rational point in a couple of years. So things are looking up for Intel, and it's a very hard stock to place a value on because their numbers are they're unused. They're not useful for the last 3 years. They're not telling you what the future is. It's really about trying to forecast, what are they going to do going forward? It's a tough one to get your head around, at least my head around. When we look at their debt, 50 billion in debt, they have 21 in cash, so they have net $29 billion in debt. Debt to EBITDA 5.37, just because the profitability is down so bad. So they got to get their profitability up, pay off some debt. Maybe these partnerships are going to help them. If those partners infuse a little capital, they're going to have that capital to work with and get back on track. Intel used to be a dividend payer, but not for now. Maybe in 5 years they'll return to paying a dividend, but for now they just got to figure out how to repair the business. But the stock price is moving. It's those who played this one right, congratulations. You are sitting on a very good gain. And I think they're probably going to hold their stock price for a while. If anything, they might continue to rally. It might settle down a bit. But I don't think that the stock price is going to sell off, because right now the stock price is not based on their profits because they don't have any. Not based on cash flows because they don't have any. It's based on the investing community's expectation that 3 years down the road, Intel is going to be an okay business again. It's going to be a good business again, especially if they have partnerships with some of the, some of the world's best brands, NVIDIA, Apple, the U.S. government is taking a stake in Intel. So those things are probably going to help the stock. So any other comments on Intel?
Yeah, I was looking at fast graphs.
All right, let me give you the screen.
In there, we look at the max.
Oh, man, what happened there?
We look at the max data that we have in fast graphs, which would be 20 years. They only go 20 years back. So over 20 years, the adjusted earnings growth rate over that period is only 0.29%. Their fair value would be 9.08 times. So yeah, revenue earnings fell through the floor here. Yeah, if we just look at it 13 years, which would be 10 years in the past and 3 years into the future, then they actually have had negative operating growth rate over a 13-year span. So they're definitely expensive right now. Trading this one, I think, is probably a pretty safe bet, and even if from an investment point of view, there's not really a lot of expectations for a rate of return, but for trading it looks like a pretty good one at the moment. Congratulations, guys.
Yeah. Yep. And again, a couple of members, I know one member specifically, he bought into Intel, so good for him. Nice move. So we had a request. We have a request to take a look at Owl. And Owl is Blue Owl Capital. And these guys are down 25%, down 9%. And this company came up in my evening live stream earlier this week, And we did a full analysis on the company, so I have that research to share. I also heard that, in 1 second, had to clear my throat. And I also heard that these guys are in partnership with PayPal. So PayPal does the buy now, pay later. And it's a business model that's becoming more used, more popular, where a consumer goes and it's usually more expensive ticket item, and they buy that item. They have 4 payments, and these are quick payments. This isn't like 4 payments over the next year. It's like 4 payments over the next 45 days or so, or 60 days. And PayPal is got a relationship with Owl, where Owl is going to buy that debt, or in essence, provide the capital that's necessary, the liquidity to make that business work. I think that's a good idea for Owl. Owl is in the space of the finance sector, asset management. These guys are an alternative asset manager in the United States. The company offers permanent capital-based solutions. So they're partnering with other businesses, real estate owners, and so forth, so that they could come in as a capital partner and make money. I mean, they're not there to make friends. They're there to make money. Their stock is down over the 1 year, year to date, down. And this one here didn't quite make sense, because I'll show you where they're growing and what they're doing. But let's go over some other fundamentals quickly. Market cap, 26.9 billion, revenue 2.6 billion. P ratio looks extremely high this year, but next year looks quite reasonable at 18.75. And analysts do think this guy is, or this stock is, discounted. Dividend rate of 5.18. Hey, that looks pretty good. Take a look at the dividend history a little bit later. So this is what, I like seeing revenue growth. Revenue growth tells me this business is doing well. They're getting additional partners. They're doing more deals. 31% is very good growth. Excellent. And the way they work is they're making money not like a bank. They're more like an investor that is realizing gains and really getting their capital to work for them. And overall, their profitability is very good. Very good. They produce free cash flow consistently, just consistent cash flow generator. And their dividend per share is 0.81, cash flow per share $1.67. So yeah, they could afford it. In my book, they could definitely afford it. Their margins are good. Profit margins are okay. I think that could improve, but the free cash flow margin is very good. Let's see what analysts are saying, and then I'll show you my valuation. So we've got 13 analysts covering the stock, and they all think this is a good stock, that it's the most bearish price target is $21 per share. The most optimistic, $32 per share. So everybody's thinking, hey, this stock could go up. And let's study their forecast. They're going to keep growing. So the numbers look fantastic for Owl. I mean, every number is looking good. Profitability is going to expand. So a little bit of head scratching and thinking, why isn't the market buying into this stock? It's a little surprising that a company is operating that well and the market's not really paying attention. It's not the smallest stock you're going to find out there. 27 billion is a pretty good market cap. Can you take a look at the charts on Owl?
Sure. So I'm kind of like Mike. I've never owned Owl. I have owned OBDC, which is the Business Development Corporation. and Blue Owl Capital is their external manager. So they're related. I sold out of ODBC in favor of ARCC. Okay, so anyway, yep, they really took a hit yesterday, probably because of interest rates, if I was guessing, because they they do better when interest rates are a little bit higher. So as they're coming down, I expect to see this. If we look at ARCC, and I bet if we switched over to ODBC, we would see the same thing. So anyway, they're trading below a downward sloping 200, looks like a downward sloping 50, and a downward sloping 20. Their RSI looks like the market just opened. Looks like they're up just a bit. The RSI is turning up, but it's in negative territory, and the PPO is negative, and money flow is negative. It looks like they've underperformed the S&P 500 over the past year, underperformed the financial group, underperformed asset. Yeah, they're an asset manager, that industry group, and that industry group is just barely outperforming the S&P 500. So, one of the things I always like to do is draw a trend line across there. And I'd really feel a lot more confident when they can break above and hold above a trend line like that. So we could do the same thing across here. Maybe if we did it to there, we can see that they've broken down below that. So they would need to break above these trend lines before I'd feel really comfortable with them again. That's just my opinion.
Yeah, I think earlier comment you made really rings true in my head, which is that the declining interest rates are not a good thing for Blue Owl Capital, because they just don't have less to work with. Like if PayPal, as an example, can go out and get capital at 6% from just about anybody, they're like, geez, we can't make a lot of money on a 6% rate of return. But if we have rates up at 10, they're like, hey, great, we can make lots of money, because their alternative is to go get capital at 10%, and we can come in at 8, 9, that we'd be very attractive and have room to make money. Did you have something to share on ARCC?
This is ARCC, so they've held up a lot better than OWL and even ODBC. But with the interest rate discussions, they've been coming back down. Their book is 19.75, so that's where I tend to pick them up.
Okay. Yeah, so that's Blue Owl. Looks like Crypto K was interested. Yeah, I think the partnership with PayPal is positive. It's good, and I know that PayPal is also partnered with one of the either Blackstone or BlackRock, I forgot who, because they're in essence operating this business, and they all do the buy now pay later businesses are all partnered with companies that have a lot of capital, and they need that capital, because if they triple in size, they need the capital to cover that type of buying. And according to the economic report that Daryl had earlier, consumers are buying more stuff. And as consumers buy more stuff, they're going to probably do that buy now, pay later program. And they're going to probably feel revenues that are going to go to PayPal and the others that do buy now, pay later. And Blue Owl is going to be a participant. Now, when I value Blue Owl Capital, this is a good business. And in my from my perspective, it's a good business. It's just not an overly discounted business at this time. It's discounted by 16%, which is not like, whoa, man, I got to get into this stock, compelling. It's more like interesting. It's interesting in two ways. One, I guess the market had this stock price wrong, and it's corrected itself. It's come down to a price that's probably closer to intrinsic value. I'm taking the fundamental data that this company provides, free cash flow. I'm growing it by 15%, which is rational for this stock. I'm valuing the company, and based on cash flows, it's fairly priced. Earnings per share give us a better, more optimistic picture, a better valuation. But when I combine the two and I take more weight in the free cash flow method, I'm at a 16% discount. And that's not enough. Not enough for me to get off the sidelines and get into the game with Blue Owl. I need to see a compelling discount. There's other alternatives in financial sector that are better than that. So good questions on Blue Owl. If their business continues to grow, I think their valuation is going to change for the better, and a good stock to keep an eye on. Investing at the right time is critical. Find good businesses, watch them. May take a little while, may take a long while, but at the right times, if you invest, you'll make a lot of money. So that's Blue Owl Capital. All right, so what's going on with the stock market? It should be trading up. Whoa, that's a nice picture right there. We've got a lot of green on the screen. We got Google rising. I heard Meta is looking into using Gemini for doing a lot of ad optimization. And I think you and I talked briefly about it. I thought Meta had its own AI engine. I think they do.
Yeah.
They like what Google's doing with Gemini, and hey, can we use your stuff? So maybe Google's catching a little bit of a bid because of that. Tesla is going up. Aerospace and defense having a great day. Energy continues to go up, and oil prices were up a little higher today. Healthcare's up. Man, there's a lot of green on this. Utilities are up. Materials are up. Looks like semiconductors are up.
Yeah, everything except consumer staples are up in the sector view.
That means it's risk on. That means people read that economic report and interpreted the report, I think, in agreement with you, and I'm agreeing with you, which is, hey, the economy's doing pretty darn well, man.
Yeah.
And unemployment's not becoming a giant problem. That's good. All right, let's focus on how to grow. I think the housing market is kind of, if anything, just the number of transactions isn't very high. If that can increase as people buy and sell homes, or households move, or households are created, like a person, gets established, maybe they're mid 20s, 30s, and they're like, okay, I want to buy a house, or I want to move to a bigger home. Those events tend to drive a lot of economic activity, and the activity they drive really shows up at Home Depot. It shows up at all these retailers and online, because they usually have a significant spend. They're like, hey, I'm going to need new TVs. I'm going to remodel the kitchen, all those things as well. So it'll be an interesting metric to look at. And I think many times when you look at the real estate market, it tells you a little bit of what's going to happen in the economy. So if we can see transactions for real estate increase, I think we'll be completely out of the woods in my mind when it comes to the economy. But we'll see. We'll see. For now, it's a green day. I think we have the potential. Day isn't done yet. We just got started. We're 9 minutes into the trading day, but we were on a losing streak. Let me see if I can get back to the S&P chart. We're up 0.21. We were on a 3-day losing streak, but look at that. We're beginning to fade. Oh, no. Come on, stock market. You can do it. We were on a 3-day losing streak, and we'll see where today ends. But for now, there's some companies that are rising in stock price. All right, let me check the comments here. I was looking into FUBO TV on late night research band. So, yeah, let's take a look at FUBO, because this is an acquisition that it's been hard for me, and it looks like it's hard for other people to kind of understand what the heck's going on, because they announced that, I think, was it Disney was going to acquire them, and their stock rose. Great. And I expect, once a company is going to be acquired, the stock basically stays at that level, because they announced, hey, we're going to pay X amount for that company, and investors are somewhat assured that that's going to be the price should the governmental bodies don't prevent that acquisition from happening. But instead, the stock's really sold off. And that's been surprising to me and confusing. It's like, wait a second, what's going on? Is the acquisition off? So this one here, let's take a look at the news headlines. And I think somebody in the community one of the members has this stock. So, and I'm going to go straight to their investor page. All right, see if they have any comments on the acquisition. So, okay. So that was Q2. Let's see, news. And I've looked at FUBO in the past, but their fundamentals did not look good. And that's 25. So I think the announcement was in 2024. But nothing new in 2025. That was a press release from the company.
They are saying that deal could close in the fourth quarter or the first quarter of 2026.
So we're months away from it. Okay. Yeah, nothing new since, geez, they really have me confused. Like, wouldn't you want to keep everybody informed on what the heck's going on with the acquisition? But I guess not. And that's why I think the stock price is beginning to flounder. The thing I was going to say about their financials is, so they grow quite nicely, right? They're a streamer, they have a bundle, but once we get to the expenses, and they're really losing a lot of money, which isn't good. Their cash flow has turned positive, but for a long time it was very negative. And at least when I looked at it in the past, like last year or the year before, like 2023, it just didn't look very good. So I was like, yeah, I'm not buying into this. I get that if they get acquired, it changes, obviously it changes the whole investing story. But look at that. Even analysts are mixed. Like one analyst is it's worth 425, even though it's got an acquisition on the horizon. So this one here is kind of a mystery as to why the market is not pricing them at the acquisition price. So any comments on FUBO?
No, I can't. I don't have anything else to add.
So Mike, that's who I was thinking of. This is my second time to own it. So you caught the move, sold it, and then bought it when it dropped. Good job on that. Interesting. Yeah, the whole mystery around the acquisition. I mean, is there like some skeletons in the closet that came out and the acquirer is like, whoa, hold on a second. I don't know. They're just not keeping the public informed. And maybe that's why the stock is not keeping the price that it had way back in January 2025. So, yeah, interesting. So FUBO.
I know Microsoft's acquisition of Activision was the same way. As there was some uncertainty about the acquisition by the FTC, and the price dropped quite a bit. And then as that became a little more clear, the price basically reverted back up to the acquisition price. But that was a year or maybe a little bit over a year process.
Yeah, I owned Activision before the announcement, and then Microsoft acquired Activision, and I sold literally the next day and just took the gain because that's my preference is, I could have stuck around and probably made another 1%, 2%, because but the risk is the FTC could have said, no, we're not going to let you do that. Video games are national security item. We don't want, what's one of their big titles is Call of Duty. We don't want Call of Duty to land in the wrong hands. So I just sold, took a big gain, and moved on, and didn't have to, cling to the soap opera that ended up, obviously, all the steps they have to go through to finally acquire the business. And FUBO, I think whoever played it that way here was probably feeling like and feeling, like, hey, I did the right thing. Just sell it. You took the gain, and now the stock's settling down. If this acquisition doesn't happen, this stock's going back to $1.37. That would not be good. So that's what's happening over at FUBO.
What's their breakup fee if the deal doesn't go through? Yeah, that could come into play. Yeah. So I know for Activision, I played it afterwards, and I still made quite a bit of money on Activision. But they were going to get $1 billion, I think, from Microsoft if it broke up, which is going to be a big boost, and would have kept their price higher than it was before. So that's why I played it that way. I wasn't into it before, but I still did pretty well with Activision.
All right, we covered FUBO. And then I think KLAR, this is a new company for online shopping in Europe. And they're not the biggest company that you're going to come across. 15 billion. Wow, they're down quite a bit. Year to date, down 1% 1 year. Am I looking at the right company? Yeah. And they just IPO'd, I guess. Yeah. Yeah, they just IPO'd a couple weeks ago. And I did a review of these guys on my IPO video, best and worst. And these guys do have good growth, but it's not like incredible growth. 19% growth. That's good. They're just, if you're e-commerce and your total revenue is 3 billion, I mean, Amazon 650 billion in revenue. That's massive. These guys are 3 billion. Okay, that's good, but it's not great. And their fundamentals, the cash flow looks good. Gross margins look terrific. And profit, not quite yet because they're small. And then free cash flow margin looks really, really good. KLAR forecast, one analyst covers them, and he believes the stock's worth $53 per share.
It's the CFO.
That's the CFO?
I was joking, but
yeah. That makes sense. And then there's 4 analysts that are putting an earnings per share expectation out there, but revenue, there's no forecast out there for them. And I do have a valuation for KLAR, I believe. And I think they're 45% discounted if I value them based on free cash flows simply. I don't use earnings per share on them. And I use a very high discount rate of 12. So it's an interesting business. I just stay away from IPOs. This one just IPO'd, and the market's already kind of selling it off. And right now we don't have a lot of momentum, upward momentum. So maybe in 6 months, 12 months, this might be a good idea for me. Any comments, Daryl, on KLAR?
No, I was looking at the chart and it hadn't even been IPO'd long enough to have an RFI or a PPO or anything. So
it doesn't have a 20-day moving average.
It does not have it. It has a 5-day. I have a 5-day moving average. That's about it so far.
All right. This is a newborn IPO, so we'll leave it at that. All right. So we covered FUBO and KLAR. Perfect. All right. So back to a list that we kind of showed up to the stream with. Next stock, can we talk about UPS? Because I know you're tracking the transports, and I wonder if how UPS is doing today with that positive economic news. It's going up a little bit, and UPS has gone down a lot. I mean, this is in my mind, a very respected business. It's a consistent business. It's an important business, and has been sold off quite drastically, 36%. And I think the turnaround is pretty much kind of set. I think they've had some rough years. We're going to look at their fundamentals, but I think this stock's looking good to me. It's a $70 billion market cap. Revenues are higher than their market cap, and their PE ratio is quite rational, 12.38 on the current year, 12.79 forward. Analysts think it's discounted, and they pay a really high dividend. So that is interesting. So over the trailing 12 months, they're growing a tiny bit. They've had 2 positive quarters, 2 negative quarters, but they're pretty much kind of flat. If they could start to just grow single digit, I think we're going to be fine, because this is a very consistent business. The economic data is painting a picture that the economy is actually doing okay. Consumers are buying stuff. They're going online, ordering stuff, and probably using more UPS services. So that I think the story on the economy for the next couple of years is setting it up well to probably support UPS in its growth. The free cash flows have been better in the past, but they're down a little bit. Even though they're not doing great, they're still a cash flow generator. And gross margins are low because they provide services. They're just delivering packages. They're still profitable. I think they could get better at that. And their free cash flow is a little low for the year, but it's been higher in the past. So we have dividend is pretty expensive, $6.54, where cash flow is $4.15 for the current trailing 12 months. In last year, you could say they could barely afford it, but I think that dividend is likely going to be cut, I would think, because they're trying to turn things around. The dividend is too high. I'm not a big dividend investor. I don't mind a dividend, but I'd rather have a really strong business. And if UPS can strengthen themselves by keeping that cash and just helping grow the business, get more customers to use UPS, I think that'd be better for everybody long term. Let's see what analysts are saying about UPS. So the most optimistic analyst is at a price target of $147 per share. Stock price is trading at 83. And the worst case scenario analyst is at 75. 17 opinions being provided on this stock. So the downside isn't too bad. Upside looks pretty darn good. So that looks good. Let's see what the forecast is. So this is what I like about UPS is it's not about where they've been. That is important, but it's about where they're going. And if they're going to start growing, I want to be a UPS stockholder because I think the market's going to recognize, hey, look at the expanded profitability and really low PE. This stock's going to really set itself up well. And I want to be in the stock while it rallies. So before I show my valuation, did you want to share the charts on UPS?
Yeah, we can take a look at what we drew up here a week or two ago. So the changes from this chart compared to what I normally show is I've changed the 20-day moving average to a 21-day exponential moving average. And I use that when I'm thinking about adding to a stock or initiating a holding. It's currently trading below that. So one of its first challenges is to at least get above that 21 day and have that start turning positive. I did add a few shares here 2 or 3 days ago. Then we added these trend lines, a shorter term trend line tied to the peak in January down across this top. So the 50-day would be a little bit of resistance, and this trend line is going to be a little bit of resistance, but I'd love to see it break out above this trend line to show that it is getting positive momentum and reversing this lower highs trend. Then we have another trend line that goes back even further. Let me see how far I drew that trend line. It's pretty long. This one goes all the way back to July of 2023. So this is really when that trend line started to form. So now I'm going to go back out to a year, and to break that 3-year trend line would need to break above this dotted line I have here. So that's at about 114. So I'm going to watch this one patiently. I'm not going to, make it not going to add aggressively to it, but I'm going to be watching this one You mentioned the major indexes. So transportation is one of those major indexes. And we showed this last week. And the one thing that changed this week, looking at a 1 week view, is transportation moved to the top of the indexes as far as performance. That's the first time this has happened this year. So if we go back 1 month, transportation was at the bottom. If we go back 6 months, transportation was at the bottom. We go back year to date, transportation was at the bottom. So this is the first week that I'm really seeing transportations start to get a bump. So as long as the market thinks the economy is weakening, then your supply chain slows down. You don't have to move as much stuff around, and the pricing in those that are in that line of work are going to suffer. So now that we're starting to get more positive news that the GDP and what have you is growing, people are starting to buy back into the transportations, which could be good for UPS and FedEx and any others that are in this line of business.
Yeah, the situation is improving for UPS and transports. I think the economic news is probably the biggest part of, the story. Is if the economy does well and people are buying stuff, they're going to do well. So that makes sense. All right, so let me take a look at the valuation of UPS, and then we'll kind of close out UPS and move on to a request. So UPS, based on my research, I conclude that it's 40% discounted. Each share is worth $138 a share. And right now the market's selling shares for $83.44. The cash flows are good. They're guiding. They provided this guidance. They're guiding that the free cash flow is going to come in actually higher than 5.5 billion. And I'm using that and then growing it. We saw that their forecast is for them to grow. So that's good. And I'm not growing by like leaps and bounds. It's just a little bit. And then long-term growth at 4%. It's a really good business, 8% discount rate. So when I use that, I get a discount of 38%. And earnings per share is actually a little better, 43% discount based on the earnings per share that they're guiding on. So, or I should say that analysts are forecasting. So I think it's a really nice risk reward situation. I'm buying into UPS. I'm establishing a good position. There's a couple of things that go through my head when I invest is what's my confidence level? How much do I believe in the business? How high do I think the stock's going to go? How much am I risking? If it's a business that is relatively young, unproven, it hasn't been, in other words, a veteran of their industry, then I have less confidence. And you think about it, is a young business, it's great to see them grow, but maybe the established competitors are going to figure out how to beat them and how to take away their market share. That's a risk. There's a lot of things that play out in my confidence level. As I look at UPS, they've been around for 100 years. Yeah, they've seen booming economies, recessions. They've seen wars. They've seen 9/11. They've seen COVID. They pretty much have seen it all. And there they are, doing what they've been doing for 100 years. Culture is good. So I just need them to be UPS, and I think the stock's going to perform quite well. Having said that, it's the kind of stock that I'm very comfortable putting a big position on because I think it's just going to perform well. It's going to do 15, 20% rate of return for the next 5 years. And I'll be good with that. Be like, great. It's a good place to put capital. And I'll take chances as well with some lesser known names that could really, really accelerate the growth of my capital, but they come with risks. Some of those end up being big giant losers. And that's part of the game, right? How much risk are we going to take? So that's my story on UPS. Thanks for covering the charts. We have a request. Little J wants to look at Electromed. I think it's my first time ever looking at Electromed. They develop, manufacture, market, sell airway clearance therapy and related products that apply high frequency chest wall oscillation therapy in pulmonary care for patients in the United States and internationally. The company offers Smart Vest airway clearance system for patients with compromised pulmonary functions, including bronchitis, cystic fibrosis, or as well as neuromuscular conditions. Okay. So this is a newer business. Let's take a peek at their website. So here's what their product looks like. And I wonder how it functions. It looks like a vest. Okay, so this is probably just going to help your lungs kind of exhale and inhale, I imagine. Okay. So that's what their product is about. See how they're growing and so forth. So this is medical devices in healthcare. Small cap, $201 million, 1 year, up 17, but they hit a 52-week high of $35 a share, really sold off, and have been rallying since then. The 1 month looks good, but it is a volatile stock. They have revenues of $64 million, PE ratio at 27. Analysts think it's discounted by 47%. And this PE might be rational depending on growth. Let's take a look at how the business is growing. So they're really small, right? And they're not growing very fast. So if you're a business at $64 million of revenue per year, 17% growth is not amazing. It's okay. It's good. But my concern is it's just not, their product isn't being adopted all that quickly. If it was like a breakthrough, boy, it's just going to, they're not going to be able to produce enough units. There's just going to be so much demand for it. I think this is probably a therapy that is something some doctors are comfortable with, and maybe some doctors are not comfortable with or not believers in. 17% growth is not amazing. They are profitable. I would have thought that they would be less profitable than they are because they're devices. They have to make something, they have to put materials into the product and so forth. But their gross margins are quite attractive. So that looks good. Profit margin is good. So these fundamentals look good. Just that growth is not exciting me. I'm like, geez, you're small and you're not growing. So why? And you've been around for a while, 2018 to now, that's 7 years. And I would think that you'd be growing much faster. You'd be a lot larger if your treatment is really, really working. Or maybe the addressable market isn't all that big. Either one is not good. Analysts think that it is, there's two analysts covering it. They think that it is discounted. It's kind of a moderate growth company. It's really tiny, and they're supposed to slow their percentage growth down. See, these numbers are tiny. They should, if anything, accelerate their growth. Hey, we're growing at 60%, 70% a year because we're tiny. So this is not overly exciting for me. The earnings per share is growing nicely. That looks good. But this is kind of resembling a business that is more like 20 billion in revenue and has a mature business, and they continue to grow, just not as fast as when they were little. So that's what's going on there. I could do a valuation on this. Could you show the charts on Electromed?
Sure. So I did add a couple trend lines to this one from this peak here and this peak here. So it would need to break above the trend line to break this downtrend. It is trading below or maybe just slightly above the downward sloping 20-day moving average. It's trading below, even with the bump today, below a downward sloping 200-day. It is above a 50-day upward sloping moving average. The PPO, the RSI is sitting right at the midpoint. The PPO turned positive somewhere around the 19th of August, rose quite rapidly. We had a bearish crossover in bullish territory. Looks like about the 15th of September. So, and that looks, the divergence between these two moving average is a little larger than even it was yesterday. Money flow was bullish, but has now moved down into no man's land at the moment. So I'd be looking for a break above this trend line somewhere around 25 before I got terribly interested in it from a technical perspective.
Yeah, and curiosity, like, does your analysis change based on the size of the company? Like, if it's a small company, you kind of view it a little bit different than a very, very large, well-established company?
From a technical perspective, not really. I follow a very similar fundamental analysis as you do. So I always take that into consideration in equal measure with technicals. But I'm just looking at a chart. I've never heard of this company. I had no idea what they did. But I'm looking at the chart. And from a technical point of view, if I were to invest from a trading perspective, I would need to see it break above that trend line. I don't care how big it is. I'm just looking at technicals here.
Mm-hmm. Okay. And give me 1 second. I'm almost done. Okay, looks good. So it's a really small cap. The market hasn't really been excited about the stock. It's small. I think the growth is causing investors to maybe think twice about the stock, but it is discounted based on its cash flows and the fact that it should generate more cash flows. It's a treatment that's going to grow. And this might be overly optimistic there because their growth rate was going to drop. So I'm going to lower that to 7%. And then long-term growth to 4%. The earnings per share is supposed to be 99 cents per share next year. And then PE ratio, I'm going to give them an 18. I could think about a 12. For sure, 18 is my upper limit because they're small and their growth rate of 10% on earnings per share. So it's about a 10% discount on a very small stock. And for me, it's just not worth the risk. Because if they have a bad earnings report or just their growth slows down even worse, it's just going to be my capital just going to sit there. It's not going to perform. It's a really small company. If it's a small company like this and they were to grow fast, like 80% growth rate, then I'd be excited. But it's not. It's been growing slowly year after year. So it would be a pass for me. Not enough discount. It's not compelling. It wouldn't be an investment I would make. But thanks for asking. I hope you found the analysis interesting. All right. That was Little J. Thanks for asking. Good to see you. All right. So back to Activision. Ben 10, when he was in the Navy, played Call of Duty. I invested heavily into Activision. There we go. So, all right, cool. So we caught up on request. Let's see where the market is trading. So we've got come on now. There we go. Wow, the market's kind of settled down, huh? The market is not in a mood to rally this week. NASDAQ is down a little bit. S&P is up a little bit. Dow is up. Those transports, I think they kind of go into the Dow a little more. Small caps are doing well. And when we look at a heat map, yeah, Meta's selling off, Apple's selling off, Nvidia's selling off. So these will move the market. These are big caps. United Healthcare selling off. There's a lot of green in healthcare, utilities, real estate, energy's up with the exception of Chevron, which is flat, but Exxon is really moving. Go Exxon. And then we got some green in aerospace and defense. Financials are moving. So there's some green out there. I think some investors are going to be happy today, but the index is down for the NASDAQ because of Meta, Apple, Nvidia, Broadcom, AMD. So that's what's happening in the market. So I think I've got a question here for you, Daryl. Can I ask Daryl what metrics he uses when taking profits for his options trades?
Okay, so if I'm doing covered calls, I usually just let those expire. I used to sell them quite frequently for a penny or so after they had decayed to that, but now I just let them expire for my covered calls. For any other kind of options, I don't use fib extensions there. I usually wait for at least a 50% profit, and then I start getting interested in closing out an option. If I think the chart is still in my favor, then I'll let it run up a lot higher than that, maybe to 75% or so. That's typically what I do with my options.
Thanks, Daryl. All right, let's do one more for the road, and let's take a look at Fortinet. It's Fortinet is a cybersecurity company. Started tracking this a couple months ago. I felt like it was the best priced cybersecurity company, and part of that is the big sell-off, that has transpired over the last 6 months or so. And this was after an earnings and their guidance and so forth. So I took the company, valued it, and thought, hey, this is the best, I think, priced cybersecurity stock in that lot. And so far, it's been good for me. It's been going up. I think it's a good stock over time. I think for the long haul. It's a $64 billion market cap with revenues of $6 billion. Their PE ratio could be interpreted as being high, but we'll look at their growth rate in a bit. Analysts do think it's discounted. And the reason that PE may not be all that high is because of the growth rate and their profitability and so forth. Their growth rate is consistent. They are growing at 14% on a pretty good size number. $6 billion in revenue is pretty good size. And when we look at Fortinet's Other fundamentals like free cash flow rate, gross margins are excellent, 81%. Profit margins, 30%. Beautiful. The ratio for software companies, that is just a quick ratio, is if you add profit margin with growth was 14, and you get above 40, that means it's a good investment in a software company. And that's the case for Fortinet. Free cash flow margin 32. So these numbers, I mean, this is like beautiful. This is very, very good. This is a very desirable business. These businesses, as they get bigger, they just produce more profit, more free cash flow because they have higher percentages. It's just it's a good model. That's why these businesses are worth what they're worth. And this one is being discounted, sold off. So that's why it caught my attention. Now the forecast, 30 analysts are weighing in. Upside, the stock can go up to $130 a share, can come down to 67. And on average, it's discounted by 12%. Let's look at the forecast. They're going to keep growing. Well, if they grow at this forecast, I am good. I will continue to buy shares in Fortinet. I own a good starting position. It's beyond a starting position, and I could really see myself buy into it. I took the same approach with Zscaler. It worked out really nice. Zscaler was sold off. There was doubters, and that's been the best performing cybersecurity stock over the last 12 to 18 months. Much better than like CrowdStrike if you bought at the right time. I certainly did, and I took my profits, and I'm trying to do the same thing with Fortinet. And if they follow this growth trend, I'm good. This is going to be a really, really good stock because the PE ratio is going to move. Look at that. And you're going to have a desirable business with growth. And I think it's going to stay at a PE ratio of like 35, 36. But what's going to move is the stock price. So I have it discounted. I'll show that to you. And I don't know if you've got charts to show on this stock. I wanted to see the charts. So it's a favor that I'd like to ask you is, can you show the Fortinet charts? Because I actually brought this up because I wanted to see your charts.
Yeah, I've got them.
Awesome. All right. I guess I should be very transparent in my motive. So I think Fortinet's discounted by 32%. That's a very nice discount on a very attractive, desirable business. So I'm in on Fortinet. And again, this approach worked on Zscaler. I'm hoping that it works again here with Fortinet. We'll see how it goes. And I've got a comment on Fortinet that I'll read after your chart, sir.
Okay, so I don't own this one, but I do own some other software companies, and they're kind of all in the same boat right now. The sentiment is just not where I would expect it to be based on the fundamentals for those companies. So when we look at the chart, we're seeing that the sentiment is definitely down despite, the company's fundamentals, including the other ones that I own, not Fortinet, but other ones.
Mm-hmm.
So the 200-day is declining, the 50 days declining, the 200-day is rolled over from the bottom and is back up. RSI is kind of right in the middle. PPO barely positive, 0.111 at the moment. We did get a bullish crossover in bearish territory on the 25th. I'm encouraged by the accumulation distribution line. It's at a 52-week high. So despite this drop-off, money was moving in, which tells me that those that are in the know took advantage of this and started buying it. So we could draw the trend lines. I mean, on something like this with the fundamentals looking so good, you're going to buy and hold it more than likely. But, to really break this downtrend, it would have to get above about 102 or so. I'm not even going to draw a shorter term one. It's below that at the moment, but we'll use the 50-day moving average instead. Would really like to see it break above that 50-day moving average and hold that. Then it's going to face a bit of resistance at the 200-day moving average, which will be declining as these prices stay below it. That 200-day is going to be declining. We'll come down and meet it at some point, but I'd really like to see it break above 101 or so, which would say that yes, the sentiment has shifted back to a positive state, based on the fundamentals that you shared with us.
So, quick question on the screen that you've got there. You see the volume there. Does that mean we've got a lot of buyers and a few sellers, but that's a pretty good looking volume of buyers, correct?
Yep. So you do see an increase, and this blue line that may be hard to see for you, but that's a 50-day moving average of the volume. And I can see that it is increasing. So the volume is increasing over this time period.
Mm-hmm.
That's always a good sign, especially if the accumulation days are above that 50-day moving average. So we had a big sell-off. No surprise there that you saw a lot of sellers. The sellers continued the next day. And then we had buyers stepping in, and there was pretty big volume, more than the 50-day average. 3 days in a row, and then a couple days in a row, a little bit of selling. But there are some buyers stepping in. Looks like we had maybe 2 or 2.5 times the amount of volume on the 19th.
Mm-hmm.
We had a couple sell-offs this week, but that's not to be unexpected given the overall market.
Mm-hmm.
So
Mm-hmm.
it's good to see higher volume.
Yeah, thank you, man. Really, I'm getting more confident in the stock based on your charts here, and I'm going to keep buying into it. I'm going to accelerate my buying into Fortinet. ASML, we don't have to look at ASML, but I'll tell you, ASML rarely provides like a strong proposition to me, and it recently has. And I bought ASML as fast as I could, and it's been hard because it's been going up. And Fortinet is a little bit of your charts tell me that I'm not the only one that is believing Fortinet could have a nice recovery here. So, having seen your charts, I'm going to accelerate my buying. Okay,
Yeah,
we have.
to me,
Go ahead.
this is we just got to wait on the sentiment to shift. I think software has just had poor sentiment. That industry as a
You are
whole has just had some downward pressure as far as sentiment. It'll correct itself eventually.
so. I think that software is a big category, right? You got kind of like Salesforce. Now that's just been sent to the doghouse and hasn't been let back in the house um, for a while. Adobe, it's in the doghouse. But then you have certain stocks like AppLovin's just killing it, Palantir crushing it, and cybersecurity is a category that also catches a lot of investors. So I would agree with you. Kind of like some software is just like beat up and just left for dead. But you kind of study what has been working, and there's certain spots that are just killing it. So the fundamentals are really good on the stocks I named. But good point. We have a sponsor for a super chat. So let's move to that. We got Lauren. Good to see you again. You are a regular now, and you're a regular super chat buyer. Thank you. Appreciate it. We're going to go over BE, and that is Bloom Energy. And Bloom Energy designs, manufactures, sells, installs solid oxide fuel cell systems for on-site power generation in the United States internationally. It offers Bloom Energy Server, a power generation platform to convert fuel such as natural gas, biogas, hydrogen, or a blend of these fuels into electricity through an electrochemical process without combustion. The company also provides Bloom Electrolyzer for producing hydrogen. It sells its products through direct and indirect sales channels. So I've heard of this technology for 30 years, fuel cell, and it was something that has been worked on for a while. How are these guys doing? Not bad. 570%. Wow. Okay. Up 207%. So let's see. Yeah. Okay. They've been around for a little while. What's their max? So it looks like they IPO'd back here. So they've been around for 7 years. And we're kind of trading down for a while. And then AI, data center, we're going to need a lot of power. That story has taken this stock really high. They've gotten up to $16 billion in market cap. Their revenues are $1.6 billion. That's not bad. 10 times revenue, not bad. P ratio is extremely high. Forward P 119. Analysts can't keep up with this stock. They think it's being priced 39% too high. So let's take a look at growth. So they have a revenue number of 1.6 billion. They've been growing consistently for the 7 years they've been around. And more recently, their growth has doubled from 10.5 up to 22.72. I like looking at the quarterly because it shows me, do we have some standout quarters? Now, these guys are delivering, I'm going to call them systems, big systems, right? And their quarters could be lumpy. You could have a big quarter and then the next quarter could be a little bit light and so forth. But these are some good looking quarters. 60% growth, 38% growth, 19% growth. Very good looking growth. And you see the dip in the stock, maybe because investors are looking at Q2 and saying, well, what happened? Well, the compare was a little tough. It was a positive quarter. And again, when you have system sales like these, they could be lumpy. But I think this is good. All right, let's look at how profitable these guys are. That's important just so that I know how attractive is this business to me. Gross margins, 30%. Well, they're not as attractive as Fortinet at 80% margins. Fortinet, 80% margins, 30% net profit margin, 30 some odd percent free cash flow margin. That's a really, really desirable business. This one, not so much. It has improved its gross margin to 30%, but the maximum they can make in profit, if they didn't have any accountants, they didn't have an HR department, they didn't have R&D, they didn't have engineers, they can make 30%. Well, that's barely keeping up with Fortinet at a profit margin level. They'll never be that because they'll need their engineers and their accounting team and all that stuff. So this one will always be kind of a low profit situation because it's just what it is. They have to put a lot of money into their product, quality materials, quality employees that know what they're doing, because these are power generating units that take a fuel. So they're combustible. They're a hazard. So it has to be constructed correctly. All that shows up in your profit. The more money you have to put into that profit before you sell it to your customer, the less profit you're going to have. So these numbers are undesirable to me. These are undesirable margins, profits, cash flows. They do have a little bit of cash flow here of $44 million. And I'm going to note that. Let's take a look at what analysts are saying about these guys. And we have 19 analysts covering them. $105 per share is the best price target. But there are analysts that are out there kind of with my eye to, to the net value of a business. And they believe this stock is worth $10 a share. So there is a wide dispersion on valuations from these analysts. And they think that the stock's really risen and it's probably 39% too high. Growth is going to continue for 2 years and then kind of slow down. The growth does look good. I agree. I think the growth looks good. Profit is going to expand nicely. Profit for 2026 is 88 cents. So that looks good. And it's expanding. But again, their net profitability is never going to be awesome. It's never going to be like Palantir, Fortinet, or a biotech company that has 85% margins. Just never going to be that. And a lot of analysts cover it. So that forecast has a lot of legitimacy. Let's look at their balance sheet. Just double check. This is a business that if they have too much debt, it's going to be a problem. And I don't think they do. They're going to have net about $949 million of debt. But I take that back. Look at this debt to EBITDA number. Almost 10. 3 is my max. And it's because of that darn profit, right, that I was talking about. Let's kind of think through this. You got $950 million of debt. You don't make a lot of money because these units cost a lot of money to make. Once you got it fully made and you can deliver it to the customer, you have a lot of money in that product cost. So it's very hard for you to get that gross margin and EBITDA in order to pay off debt. Potentially it'd take you close to 10 years to pay off your debt unless you grow really fast. They are going to grow, but they're not going to grow that fast. So this is a major issue for me. It'd be one thing if it was like at a 4 and they're growing. Well, I think they can grow into that number. I saw Broadcom do that. But geez, 9.5, that's a big, big issue for me. That's a heavily indebted company. And I'm willing to bet that this number is going to show up in their valuation 2 ways. The discount rate's going up and the debt number is going to bring down their value. So could you show the charts on this while I prepare a valuation?
Sure.
Thank you.
So I'll step over to fast graphs first because they are priced at a premium right now. So that kind of validates what Victor was saying. But from a purely technical perspective, I love trading breakouts like this. So I don't have high conviction in what I'm seeing with the fundamental numbers, but this chart would be one to have fun with on some trades. So whenever you see a consolidation that started somewhere around the 14th on a price gap, and then it consolidates for 8 months, and then all of a sudden breaks out. These are very powerful breakouts. And if you were buying on that breakout, you went from 33 to 86 in less than 2 months. So at least a little bit over a double. So things I would look for here if I were trading this, it is getting some selling pressure here. But if I had bought this on a breakout, I would have a 21-day exponential moving average, EMA. It needs to hold this 21-day for me to stay in on purely technical trade. basis. I would step out if it fails to hold this by the close of business today. Then I would either sell this afternoon or I'd be looking to get out Monday morning. If I was trading it purely on technical breakout. The RSI has dropped down to 57. It's still in bullish territory. The PPO has been positive since about the 5th of June. It moved into positive territory. Consolidated here for a little bit. We had a bearish crossover in bullish territory on the 23rd. The accumulation is at a 52-week high, so people are still buying here, which is why I would want to see this hold that 21-day moving average. So that's a purely technical view, and this would only be a trade for me.
All right. So, when they put on a movie and you see the rating, you got PG, PG-13, rated R. This is going to be rated, 5 Rs.
Mhm.
Here's my valuation. It's priced 85% too high. Whoa. What are we talking about here? This is like, we're coming up on Halloween. So the original Halloween movie, right? Or The Exorcist, if you remember those movies. Boy, those were scary movies. This is kind of a scary situation like that for me. And here's why. So I went over the undesirable aspects of Bloom Energy that, hey, their gross margin, they have a very high point at 30%. Other years were like at 20, 25. They'll never be a high free cash flow company, high profit company. It's just not in the numbers. So I used their trailing 12 months, and I'm actually growing them at a very accelerated rate of 20%. It matches their growth for the first 4 years. And even with that growth rate, it just doesn't add up to much. And then I'm going to keep the growth rate accelerated at 5% for terminal value. I'm up to a 10% discount rate. I showed you their balance sheet. Again, that's a scene where Jason's coming at me with a old school hockey mask and a knife. I just don't like the scene. It's too much risk. So that is really going to bring down the value of the intrinsic net present value of those cash flows down to 1.4 billion. I'm going to add cash, and then here's that debt again. Take away debt, 1.5 billion. Somebody's going to have to pay that debt off. It's like, it's the business is a little underwater. Equity value 464. Market cap 18.8 billion. Incredible. Why am I so different, right? There was an analyst out there that was at $10 a share. And I guess he's more optimistic than I am. And I might be wrong. It's kind of like what Warren Buffett said. It's better to be generally right than precisely wrong. I think I'm generally comfortable with this position. And here's why is why has this stock moved? The AI story and the story that data centers are going to need power. I absolutely agree with that. Absolutely. But I'm going to use an analogy I've used before, which is we're in football season and we've got the champion Philadelphia Eagles, and they won the Super Bowl and they're having a good season. I think they're 3-0. And you have the organization, and when they won that Super Bowl, everybody gets a ring. Okay. Quarterback gets paid $50 million and he gets a ring. Then you have the equipment manager, really professional about his work. He gets a ring. He's very proud of his job, shows up, works 60, 70, 80 hours a week, especially during the season, really brings it. So the Philadelphia Eagle organization is having a great year, and everybody's stock is up. Everybody likes everything about the Philadelphia Eagles. I'm sure some people don't because they're loyal to their team, but just go with me on this analogy. So if you have a choice, okay, and would you rather have the job? Would you rather have the investment of the income that the quarterback makes at 50 million or the equipment manager? They're in the same organization. The AI build out. Would you rather the quarterback NVIDIA be your role or the equipment manager, which is some businesses that are involved in the AI build out that just don't make a lot of money. The equipment manager brings it, but he makes maybe 75 grand, 100 grand a year. Not taking anything away from that person. They really are important. It's just very different economics. So that's what I see is happening with the story. The AI story is kind of being used to fuel a lot of stock prices, and investors are like, yeah, look at the growth, 20%, 25%. Yeah, it's fine, but they'll never be able to produce a lot of cash, a lot of profits. What about the debt? So Bloom Energy is wow, it's really something. Earnings per share only gives me a value that's closer, but not there. It's based on earnings per share. It's worth $28 a share, but it's trading way up at 69. So Bloom Energy is a pretty scary valuation for me. If anything, I'm going to watch to see. I think these stocks are going to punish investors over time. I I have a bias, which is my bias is I like high growth stocks that make a lot of money through the form of high profits, high gross margins, that produce a lot of high free cash flows, that have great balance sheets. That's my bias. And it's businesses that are opposite to that, I don't like. So that's my analysis on Bloom Energy. I appreciate you bringing it up because it's really interesting.
Let me show one more thing on the chart that might be interesting.
Okay.
Because you
And
see me use these trend line chart or trend lines a lot. So
okay.
going back to 2021, they started a downward trend that went all the way, it hit the last peak in January of 2023. So they've been in a downward trend for a long time, but once they broke above that trend, then that trend line served as support. So if you weren't in it here, this would have been a beautiful, from a purely trading perspective. I'm not talking about an investment.
Mm-hmm.
This would have been beautiful to get in on that. The second you saw that trend line hold, that would have been a great time to be in. And I see this on quite a few charts. I bought NVIDIA like that. I bought Costco like that. A couple other ones that I bought with these breakouts like this. That'd have been a beautiful one.
So you're giving me a jumping off point on making one important point, which is, as an investor, you need to determine, what kind of investor do you want to be? And that's a big question. That's a question that you don't have to answer, today. And then that's what you're going to do for the rest of your life, right? You can evolve. But the way that Daryl can make money on this stock is absent of evaluation. And if you don't mind me saying, it's a short to medium length strategy. You wouldn't buy into Bloom Energy and say, I'm going to hold it for 10 years based on the charts. You're buying it based on a
Absolutely.
trend you're seeing, and you may take that profit in 27 days or 3 months or 5 months when you see the
Absolutely.
conditions change. So if that's the investor you want to be, more power to you. Go make as much money as you want. Okay. There's probably, and I'm going to probably simplify it. There's probably 1,000 different investor types. There's super short investors that are day trading and trying to make money in the next hour. And then there's Warren Buffett likes that buy a stock like Coca-Cola, own it for 40 years, have a cost basis of nothing, and it's all profit. Okay. And there's everything in between. And depending on what is the investor you want to do? What fits your personality? What's fun to you? What's gratifying? Like for me, picking a stock up that is super discounted and then 2 years later I'm sitting on a massive gain, that is la creme of la creme. That's like, wow, man, that's awesome. That's so fun. And it's funner when it's shorter term, by the way, rather than waiting 2-4 years. What if I went, crazy in 2-4 months? That's funner, I must admit. But pick the investor you want to be, and then, have that match your personality, what you're good at, your strengths, right? Back to the quarterback, equipment manager analogy of the football team. If you really love playing defense and you love the free safety role, learn to be a free safety. If you love catching passes, or if you love blocking on the offensive line, be an offensive lineman. Okay. Just go to where your strengths are, go where you think you can make the most money, that you feel like you can have long-term success. But it's not about, hey, my approach is better than Daryl's. No, Daryl's approach is perfect. If it matches up with what he's trying to do, his goals, what his strengths are, it's perfect. He ought to keep digging in the veins of value that are yielding the result he's looking for. And same thing for me is I'm going to keep making money the way that I've figured out how to make long-term kind of investing, and continue to get better at my craft, which is investing long-term based on valuations, trying to really understand businesses, seeing what is desirable to me, and then going deep into those desirable businesses. All right. So we're going to do one more, and then we're going to call it a stream. We're going to talk about Instacart. Instacart is, not being respected. It's like that athlete that keeps putting up good numbers, but all the analysts and media are talking about somebody else. A couple of things I like, since they're down, I want to talk about the positives first. So on the Costco call, I heard they're in partnership with Instacart, and Instacart does deliveries for Costco. Well, that's big volume. That's a really good partnership. Second, these guys are growing. Okay. They're growing nicely, 3.5 billion in revenue. They don't carry any inventory. They're just basically delivering, and they don't even hire the employees. So they're gig workers. So it's 75% margins, back to my desirability. So it's 75% profitable at 13%, free cash flow margins almost 22%. So I like this part of Instacart. I would love if they could change this into a 20% growth. But let's not wish for miracles. Let's just be realistic. Good news is they're consistent. And if they keep forming partnerships like Costco, not saying they're partners with Walmart, but like Walmart, they're already partners with like Ralph's, Kroger's, and so forth, then I think Instacart's going to be fine. I'm an Amazon stockholder, and I think the market believes Amazon's going to take away market share from Instacart, because Amazon has a grocery business. They have Whole Foods, they have Amazon Fresh, and they want to deliver that food. I get that. I don't think it's a threat to Instacart. I'm sure everybody's got different tastes when it comes to what we eat and so forth. My family is an example. We've tried Whole Foods. It's neat, but we shop at Kroger, Costco, and Trader Joe's. Trader Joe's and Kroger's being like our go-tos. That's where we think they have the vegetables and the proteins and the stuff we like. Whole Foods is neat, but it's kind of a lot of craft items that are neat to try once in a while, but not necessarily like exactly what we eat all the time. So, and I'm sure somebody loves Whole Foods. There's people out there. Back to Instacart is we're an Instacart kind of family. We've used it, especially during COVID, and we're happy with the service. I think they specialize in grocery delivery, which is very important, right? I don't want like my food to be, you know, in handled improperly. And I think Instacart does a good job of handling your food properly. One of the things that irks us is sometimes we get food delivered and we put a bench in front of our front door, and some of the delivery guys put the food on the floor, and it's like, guys, there's a bench right there. Please put it on the bench. Don't put it on the floor. And the Instacart guys are usually pretty good about delivering stuff and doing it right. So I don't think it's a direct risk or threat to cart. And the valuation of cart is really good. I think the valuation is compelling. We got 56% discount. If you measure, again, desirable business, high margins, high cash flow, high all kinds of good stuff, I have a higher discount rate because they are smaller. They have these competitors like Amazon. But when it's all said and done, it's a nicely discounted stock. So I've been buying Instacart. I've been buying into this weakness, into this fear. And I think the fear is going to go away when Mapleberry just keeps putting up good numbers. And if they could keep growing the partnerships, it's going to be, it's kind of like Amazon against the world, right? And if Instacart could just be the delivery mechanism to the rest of the world that is against Amazon, they're going to do great. So we'll see how it goes. Do you have any charts on cart?
You bet. I was also going to look at Farmers Market because they were a potential buyout by Amazon, and then they end up going with Whole Foods, and it really hurt their price over the short term. But then look what they've done over the last 4 years. So I mentioned that because.
So this is Sprouts, right?
Yep, that was Sprouts.
Yeah. Incredible.
So they were in a similar position because I'm also a cart stockholder. Here was the announcement that Amazon was moving into fresh food delivery. So they took an 11.5% hit. And then this was the announcement that Amazon had partnered with Winn-Dixie, and they took a 8% hit on that day. So these are not unlike what happened to Farmers Market 5 or 6 years ago whenever Amazon had them as a potential buyout, and then they end up going with Whole Foods. They thought it would really hurt someone like Farmers Market. When you look at the price over the last 5 years, it hasn't hurt them at all. Short term, the sentiment is going to hurt them. So we could draw some trend lines across here where you'd really like to see it hit to get out of this downward trend. But we could do that on a short term and a longer term. So on a short term, it'd be, around 44 or so. You'd like to see it recover and break above that. For a little longer term, it really needs to get to about 55 or so. But this may take some time. I mean, Amazon, when they walk into the room, they kind of suck all the oxygen out of the air.
I know.
So,
and I'm playing both sides, right? Like,
yep.
I'm a big Amazon stockholder, by the way.
Me
so
too.
I'm not here to badmouth Amazon. I'm like, hey, go Amazon. But I'm also realistic, which is, hey, you can't be all things to everybody, Amazon. You're going to have limitations. Thank you, Joshua O'Brien, for becoming a YouTube member. Thank you so much. Please get me your email. I'm going to put my email in the chat. Please email me so I get you on my list and make sure that you're getting all your benefits as a member. Thank you so much. Anything else on Instacart?
Nope, not for me. I'm just waiting for for the sentiment to recover.
All right. Well, excellent work today, Daryl. I
Thank you,
really
Victor. You
appreciate what
too.
you do. I really get a lot out of what you do. Thank you for covering Fortinet. It was one of the action items I had for myself. Is I got to see the charts, and I got to have you look at the charts and interpret them, right? So that's it for the stream, guys. It was an awesome stream, well attended. A lot of good stocks came up. I appreciate the super chat. Appreciate the new member. I appreciate all the members that come back and come up with the stocks we reviewed, and appreciate everybody's attendance. Daryl, great job today. Thank you so much.
Thank you.
Anything going on with your channel worth noting?
I haven't published anything new except for the Costco preview. It played out precisely as I kind of thought it would. So that was kind of nice. And I did sell ahead of the earnings. And look at the chart here. They are recovering a little bit since they sold off earlier in the morning. They got down to about 916 and they're back up to about 922. But I sold at 947 yesterday, about 33% of my holding.
Yep. Yeah, I'm
And
willing to bet if we come back to Costco in a month, it'll be back up to 1,000.
yeah, I will definitely pick it back up here. That was just a precautionary move yesterday.
Perfect. All right. So, well, have a nice weekend. Have a nice weekend, everyone. I'm going to stream over the weekend. I'm not sure when, but this is going to be our normal schedule next week is Monday, Wednesday, Friday, 9 a.m. Eastern. This will be your lineup. And then as we head into earnings in 3 weeks or so, we'll be ready to handle some earnings. Probably the biggest ones of the week we'll handle in the afternoons after the market closes. Maybe even 1 or 2 in the morning if you have a morning time earnings announcement. So we'll see how things play out. But with that, everybody have a terrific day. Good luck with your investments. And thanks again for tuning in.
Thank you all.